Welcome to this explainer. Today we're cutting right through all that algorithmic hustle noise and getting straight to the stark, undeniable math that actually governs your wealth. We're constantly bombarded with financial advice, but a lot of it is just designed to sell us products, not to build our financial security. So today we're going to completely strip away the hype and look at the raw numbers that quietly dictate the global economy and, more importantly, your personal bank account. Okay, picture this incredibly revealing scenario. You've got two 25-year-olds, and they both make the exact same salary. One of them treats investing like a competitive sport, right? Constantly tracking market movements, trying to pick individual stocks. The other person completely ignores the financial news and just blindly follows a rigid sequence of deploying their money. Fast forward to age 45, and that second person has nearly twice the wealth. Why? Because following a specific, mathematically sound order outpaces chasing market trends every single time. It really makes you wonder if the rules we were taught were actually just designed to sell us stuff. So let's jump right into Section 1, the optimal wealth sequence. Now, you might be wondering, what's the actual mathematically perfect order to deploy your money? Well, the crucial point here isn't necessarily what you invest in, but the exact chronological sequence of how you deploy your capital. Where your money goes first, second, and third actually matters far more than picking the perfect mutual fund. Check out these 6 proven checkpoints of the financial ladder. First up, you start with a $1,000 emergency fund, just to prevent you from liquidating your assets during a sudden crisis. Next, you capture your employer match. That is literally a 100% return, completely risk-free. Third, eliminate high-interest debt, because absolutely no investment reliably beats the negative 20% drag of a credit card. Only after that do you max out a Roth IRA for decades of tax-free growth, then max your workplace retirement, and finally, pad out a full 3 to 6 month emergency fund. Capturing free money and escaping guaranteed negative returns is without a doubt your best first move. Moving right along to Section 2, the individual stock illusion. You've probably heard of this famous decade-long wager, and it perfectly highlights a massive structural truth in finance. Warren Buffett literally bet elite hedge fund managers $1 million that a boring, entirely passive S&P 500 index fund would absolutely crush their hand-picked portfolios. And the results? The passive index fund returned 125.8%, while the highly paid professionals averaged just 36.3%. It just goes to show that expensive active management routinely loses to a product that practically runs itself. But here is the truly staggering reality behind those numbers. From 1926 all the way to 2019, the entire net wealth creation of the U.S. stock market was driven by just 4% of the stocks. Just 4%. That means 96% of stocks performed essentially like super safe government bonds. If you're out there picking stocks randomly, you are mathematically almost guaranteed to miss the winners. So when you compare the dirt cheap 0.03% fees of an index fund against the hefty 1.5% active managers charge, the math becomes totally indisputable. Over a 20-year period, more than 90% of actively managed funds underperform the benchmark index. Because an index fund automatically owns everything, it absolutely guarantees you own that magical 4% of winners without paying exorbitant fees to managers who, statistically speaking, are going to underperform anyway. Which brings us to Section 3, the cycle of mania. Let's zoom out and look at these 3 crazy historical moments. Back in 1929, an era booming with radio and electricity, the market crashed right after everyone piled in, down to the shoeshine boy giving stock tips. In 1999, it was the internet craze. In 2006, it was the whole, they just aren't making more land, real estate boom. Across 3 different centuries and 3 totally different assets, ordinary, hardworking people, following the conventional wisdom of their era, made the exact same mistake, right at the absolute peak of a bubble. This whole disaster happens because of a little thing called reflexivity, or financial mania. Basically, people stop asking what a company is actually earning, and instead they just blindly evaluate what the euphoric crowd around them is willing to pay. You're not really buying an asset based on value anymore. It's like a giant game of hot potato. You're buying a ticket in a sequential auction, just hoping you aren't the last one holding it before the music stops. Let's look under the hood in Section 4, the global finance engine. Okay, here is the golden rule of the massive $130 trillion global bond market. When interest rates go up, bond prices go down.
always, no exceptions. So the absolute crucial point to grasp is that when central banks raise interest rates rapidly, the value of old bonds issued at lower rates just plunges. Actually, this exact mechanical reality is what quietly triggered banking events like the Silicon Valley Bank collapse back in 2023. And wow, does this math scale up to the sovereign level? The US government is sitting on a massive pile of debt that was mostly issued when rates were near zero. But as that old debt matures, it has to be rolled over and refinanced at today's much higher interest rates. This deeply uncomfortable math shows that just the interest payments alone are projected to exceed $1 trillion a year. It's drastically altering the fiscal trajectory of major developed economies. So that brings us to the yield curve. Normally, long-term bonds pay higher rates than short-term ones, right? Because lending your money for 30 years is obviously riskier than lending it for 3 months. But when investors get deeply nervous about the near-term future, they rush to long-term safety, causing short-term rates to spike higher than long-term rates. This is essentially the primary warning light on the global economic dashboard. A yield curve inversion has predicted literally every U.S. recession since 1955. All right, let's bring this all back down to earth for Section 5, the real housing math.
You constantly hear people asking, should I just wait for mortgage rates to drop? Well, actually, waiting for rates to drop is often a huge mathematical trap. Why? Because the second borrowing gets cheaper, housing prices surge. It unleashes massive demand and bidding wars that instantly erase any monthly savings you thought you'd get. The alternative is the refinancing asymmetry. Marry the house, date the rate. You lock in your purchase price when there's less competition, and hey, if rates drop later, you simply refinance the loan. You can always change your rate, but you can never, ever retroactively change the purchase price. And when you finally do buy, you've got to completely ignore the industry's math. The old rule says spend no more than 28% of your gross income on housing. But look, being approved for a maximum mortgage and actually affording it in real life are two wildly different things. Lenders use your gross income, your money before taxes, to maximize their sales. But you don't pay your mortgage with gross income. You pay it with your net, take-home pay, and the bank sure doesn't care about your grocery bill or your daycare costs.
Let's put some real numbers to this. Say you're looking at a $280,000 home at a 7% interest rate. The principal and interest alone is about $1,863. That's the nice, neat number the real estate agent shows you. But when you run the real math, the invisible carrying costs, we're talking property taxes, private mortgage insurance, homeowners insurance, plus a baseline 1% maintenance reserve, they add nearly $1,000 to your monthly burden. That brings the true reality to $2,703 a month.
To put that into perspective, if you're making an $80,000 salary, your actual take-home pay is roughly $5,000 a month. If you blindly follow the bank's maximum approval, boom, 54% of your actual net spendable income is just gone. Over half your paycheck vanishes into the house before you've even bought a single bag of groceries, paid a utility bill, or saved a dime for your retirement. So I want to leave you with this final, provocative reality check. If waiting for lower rates only inflates home prices, and the traditional financial rules you were taught systematically ignore your real net income, what are you actually waiting for? It's really time to stop making life-altering decisions based on isolated variables and industry hype. Thank you so much for joining this explainer today, and remember, always look past the hype and demand to see the real math.